All right. Are we live? I think we're live. What's up, everyone? Welcome back. Welcome to the stream. For those that don't know, I am Jack Kuvek, and today we're going to be talking about. We are on Reddit. We've gone and found Reddit's top. Sorry, I had YouTube up there because I'm a complete fucking amateur if you haven't been able to notice. But I've gone and found Reddit's top startup questions of the month. And as a tech bro who's been in the entrepreneurship world for about a decade, I've built a bunch of different type of tech companies. I've raised millions of dollars from VCs. And so I'm going to go find Reddit's top questions of the month. I'm going to talk through what their question is, and I'm going to give my action and my answer. Hopefully I will have some value, and hopefully I'll have some insights. So first question we got from a Redditor. They are saying, title is struggling with getting my first customer. Hey folks, as the title states, I'm struggling really hard to get our first client for my service-based startup. Our target clients are medical doctors or NPs, mostly small clinics, practices, not big organizations. The go-to has been having someone approach the front desk as well as searching on LinkedIn and texting them. However, none of these have been fruitful at all. We haven't even been able to find a doctor who would want to use a free demo of the service either. That is a really, really bad sign. So this is a hard situation. If you're a startup founder who's struggling to get clients for a first startup, this could be a service company. It sounds like this is service-based. So what they mean by that is rather than building a software company like an application or a dashboard of some sort to solve a particular problem for doctors, it sounds like they have a service they're offering for doctors. Perhaps that's marketing their doctor's office. Perhaps that's doing accounting work for a doctor. Regardless, if you have an idea or for a company and you're trying to go out and sell it to people and you can't get one single customer, that normally means that you're not providing value, to put it very simply. If you are providing value to people and if you're doing something that people want, you should be able to get customers relatively quickly. I'll give you an example of this. So for my own life, so I coach startup founders on how to raise money. Now, I've raised money a number of times. I've actually helped founders raise millions of dollars before, and I've coached founders, but I did this for free for many years. So I wanted to see if I could charge. So I put up a landing page and I promoted a course to maybe 150 people on an email list. And I didn't get millions of dollars worth of revenue, but in my first week or so, I was able to sell 3 or 4 tickets to this course, and that was several $1,000s worth of revenue. That's not a life-changing amount of money, but it indicated to me that there was actually demand for what I was proposing. Now, I could, edit my market copy. I could actually go really deep and find better ways to promote my course and get it in front of more people. But from an initial response, I had at least some indication that people wanted what I was building. And if you're not getting any indication like this fellow on Reddit, that's a really, really bad fucking sign. I would recommend completely changing what you're doing, maybe putting up a new landing page with a completely different service. It doesn't have to be something that you've actually built, but try pitching something differently. What a lot of people like this will do is they'll be very stubborn and they'll bang their head against a wall trying to figure out if someone wants to use what they're building, and they'll never get anywhere. That's not highly recommended. In fact, it's not recommended at all. What I'd rather you do is put together a couple different proposals. It could be an email, it could be a landing page, and just write out what you're trying to do or fake an idea, and then try and get it in front of enough people to see if anyone will bite. Even if you get one person that responds and says, yeah, I'm interested, or hey, could you tell me more about this? That's something to go off of. If you're getting none of that, move on or change your pitch, because clearly either you're not communicating your value well or you're not providing value at all. And you do not want to be stuck building something that people don't want for years. I've done that in the past for stuff. I've built stuff people don't want. It's totally fine, but you should be able to get a sale relatively quickly, or at least some indication that you're onto the right track by people responding positively, doing a demo, etc. If you're not able to get anyone, move on. All right, let's see what we got next. How to raise funding. Now, this is one that's near and dear to my heart as someone who helps founders raise money on a daily basis. All right, I've been working on my startup ever since 2019. We're in 2023, so it's been 4 years. First, it was just a way to keep me employed. That's never okay. Then I hired my best friend as the demand grew for my services. Today, we're a team of 19 people. We are in the creator economy, helping consulting companies or service-based businesses, lawyers, doctors, real estate brokers, get more revenue by using media as funnels. I started this business with zero investment and grew it to 20K MRR until disaster struck and we lost our biggest account. We are now at around 12K MRR. Pause. 19 people for $20,000 MRR. Just for anyone who doesn't know, MRR means monthly recurring revenue. That's the money that you're bringing in. That doesn't take into account any of your costs associated with the business. It doesn't take into account any like Google, if you have to hosting providers, or if you're using a marketing software, or you're paying for lawyers, all of that will eat away at your MRR. So that meaning that your profit is not included in that $20,000. I really don't know what kind of business or how you could possibly have 19 people on payroll with only 20K MRR. I'm imagining that this is like, maybe these are teenagers, maybe they're young people, maybe this is in a foreign country where the cost of services and the cost of employment is way lower. But regardless, I would be very concerned about having 19 people with $20,000 in revenue. That's not a really good margin. There are a lot of businesses out there, and there are a lot of examples of people who have, $20,000 a month in revenue, and it's just them, or maybe it's them and one other person. You presumably could you want to often have a better, employee to revenue ratio by a large amount. So, that would be my first concern with this. So moving on to get through the rest of the question, we lost all the capital savings trying to recover that sudden loss. Oh, Jesus. I have all these ideas and systems that if implemented would 10x our revenue streams almost as a guarantee, but have been struggling to find investors for it. I am lost on where to even look. Any advice? So my first concern is that this isn't really a great startup company, right? It doesn't sound like they have a software. It sounds like they provide a service. Service-based businesses, I run a service-based business where I give my time to help people raise money. But the reality is it's not a software product. Startup investors and most investors want to back in companies where they have a software or some product that they're selling that can be scaled to millions upon millions of dollars in revenue. It's very hard to scale service-based businesses, which is when you're selling time and knowledge to people. It's very hard to get investment for those kinds of companies. Investors are looking for an app that can get $1 million per employee in revenue, whereas a business like this, as we just were talking about, is only able to do, tens of thousands, like $1,000 of revenue a month per employee, given that we're already at and maybe less than that, because we're at 12,000 MRR with a team of 19. That's a really low ratio for the total number of employees. So that doesn't mean it's a really great investable opportunity. So if I'm this person with this business, my first thought would be, how can I shrink our head? This might not be nice and people may get mad at me, but how can we shrink our head count to make it more of a reasonable investment if anyone were to even be interested? And then my second thing I'd be looking at once I've reduced headcount is what are people actually investing in here? Because a service-based business is not something that people will often want to invest in, because if anyone on the team dies or no longer wants to work there, that may sound morbid, but that's reality, then all of a sudden the service-based business is worth nothing because it's entirely wrapped up into the people value. Whereas if you have a software product, there's value wrapped up in software. So if you were to you're the founder of that software company and you retire, that software will presumably still be valuable even after you leave. That's what makes companies investable, just at a baseline. Now, there's many things on top of that baseline that makes startup companies even more investable, Like, is it in a really large growing market? Is it a really defensible product? Meaning, do you have some sort of technology that's really innovative, like a really unique AI algorithm? It's hot topic right now. My buddy Jared the coder might argue with me on this one. But do you have something from a technological standpoint that's really unique and hard to build, which would make this underlying software really valuable? That also adds to the valuation and the likelihood that an investor may want to invest in your company. If you don't have anything like that and you're just doing a service-based business like this, it's very unlikely you're going to be able to get investment. And I would just think about, how can I reduce my headcount as much as possible? Maybe try charging these companies more. Lawyers, doctors, and real estate brokers, they have a lot of money and they will always pay to get more customers. So if you're actually able to get them more customers with media, you should be able to charge them even more. So perhaps you're just undercharging this segment, or perhaps you have a startup that's really meant to be a 1 or 2 person company, and you need to figure out how can you get the headcount down lower to make this something that's worth your while. Because if you were doing this, whoever is writing this thread, if you, as the founder of this service-based company for the creator economy, if you were the only one running this, all of a sudden $12,000 MRR wouldn't sound that bad. $20,000 would be a hell of a lot better. You'd be making way more money. So I'd be focused on, how can I just get this to be a company that I can run on my own? You know, in my business, I might be able to make tens of thousands of dollars a month on my own for relatively few hours, because the value that I'm providing per hour is so high that I can charge pretty significant rates. So good luck to whoever this is. It doesn't sound like you have something that's very venture backable and fundable. I might consider moving on and finding something else to work on. All right. Oh boy, this is a good one. What exactly do non-technical founders do that makes them so covetable? Examples below ? Sam Altman dropped out of his first year as CS to start computer science degree to start his company, Looped. He worked so hard on the company that he got scurvy, apparently. I don't know why he included that in this post. He was later involved with Y Combinator and now OpenAI. What on earth was a 19-year-old with a high school level knowledge doing with Looped that enabled it to reach a $30 million valuation? Now, I don't know a ton about the history of Looped, but what I do remember about it is that it's a location-based service company. So it basically helped you share your location with people, or with only very specific people. So it was, without getting into too many details, it was a location-based software company that was working on location-based software before it was really popular. This was probably in 2005 or 6, or very, very early in the software world, maybe even a little bit later. But still, this was in the 2000s, and location-based technology was still in its relative infancy. And, what did a 19-year-old do to get it so far? He fucking figured it out. The reality that confuses a lot of people who, and this may be, a software engineer or someone who, isn't on the business side of things, is that, coding isn't really what often drives things forward. It's the underlying technology that makes it valuable. But getting something out into market and getting something built is there's a lot more involved in that than just coding. You have to go find, if you're Sam Altman, he incorporated the company and figured out how to do that. Then he figured out how to get customers. Then he figured out how to actually get Y Combinator to accept him. So he figured out how to pitch a company to investors that they were excited about and invested in. How did he figure that out? Probably by Googling. As someone who, I've been in a position where when I was 18 or 19, I was hired by a tech startup and I didn't know how to do fucking jack shit. But they started coming to me and asking me things like, hey, can you write a press release? And I would go, sure, I could write a press release. And then I'd have to literally go Google what the fuck a press release was, then teach myself how to do it, and have a press release published in Yahoo Finance a week or two later. That's something I literally did at 19. So regardless of your age, if you're able to figure out what your business needs to be moved forward at any given moment, you can build a remarkably valuable company, even if you don't have that much experience. What matters is execution. So I think what this person is failing to understand is that there's a lot that goes into driving a business forward, from selling the company to raising money for the company to convincing employees to join your team to figuring out something that's actually valuable that people want to buy. I mean, look at the first two posts that we were just going over in this stream. These are companies that aren't really providing a whole lot of value, or they haven't identified something that people really, really need. It's really hard to figure out what people need. It's even harder to figure out how to build what people really need and market something that people really want. If you can do that, I know that's kind of an ambiguous thing. That is the most valuable skill on the planet, but almost all of what goes into figuring out how to build something, identify what people want, and then build what people want, none of that actually requires a technical degree. It requires savviness of figuring things out on your own and scrappiness of learning independent of other people, and then also having conviction and having foresight into what will be important for humanity over the next 5, 10, or 15 years. And that's a kind of a soft skill and a learned skill that's far more nuanced than just, oh, he doesn't have a computer science degree. Now, there's more to this post, so let's get into the rest of it. Another example is Elon Musk. Jesus fucking Christ. Is this person really about to critique and go, what skills does Elon Musk have? The richest man in the world who has 5 or 6 multi-billion-dollar companies? I mean, every single company he started was something that people really wanted. I mean, to do one of these companies, to have the inkling to build ZipPay, then to be involved in PayPal, and then to be involved in Boring Company, and then be involved in SpaceX and Tesla, to have the foresight that all of these independent industries and products would be valuable, and then figure out how to build them, figure out how to hire the people needed to build them, then figure out how to get investors to give you billions of dollars for each of them. I mean, those are all skills and remarkable things in and of their own. And that's even without saying the fact that Elon Musk, regardless of whether or not you like him, and you don't have to, is clearly brilliantly intelligent. So I guess what value did they add? They did everything other than building the actual code and technology, including finding the people to build the code and technology and hiring them and convincing them to join them and then leading them and then deciding what each of these people at the companies had to work on and then effectively managing them over a course of 10 or 15 years. So, I mean, what value did they add? Leadership, ingenuity, research, fundraising, selling, partnerships, marketing. I mean, Elon Musk is arguably the best social media marketer of all time, given that he has the largest social media presence in the world. Now he also owns Twitter or X.com. But even before that, he was one of the most famous people in the world. That required a ton of marketing and promotional savvy, which is incredibly valuable. So, I mean, this is a confusing. I mean, let's just finish up the post for the sake of it here. There are countless of other examples. I refuse to believe that these folks are simply the business end folks that make fancy PowerPoints and pitch it to investors. Elon Musk, for example, stutters like nobody's business. Dude, this is the ultimate engineering dork who doesn't understand how reality works and like how everything gets pushed forward in society. I mean, this is genuinely shocking. I can't believe it. Don't be like this guy. Obviously more goes into building companies than just, or how do you build and engineer something? I mean, that is just wild. That is just wild. Oh man, moving on. Signing an NDA at the ideation phase. This is our next question, gang. Hello there. Hope everyone is doing great. I hope you're doing great too. I'm doing pretty well. I've been approached to potentially develop a software project that is currently in its ideation phase. However, there are several significant uncertainties that need clarification. First, I'm unsure about the potential for equity or payment for my work. Bad sign. If payment isn't guaranteed, it might necessitate a partnership agreement. Also not a great sign. We'll get into that. On top of this, there's now a request for me to sign a 3-year NDA. Given the uncertainties, like not being paid, I believe it's essential to clarify these points before committing to the NDA. Personally, I tend to prioritize trust and execution over a great idea alone. Thus, I'm somewhat hesitant and would appreciate hearing different opinions on this matter. Okay, in quick summation, generally speaking, if you are in the ideation phase, meaning like these people who are trying to get you to sign an NDA, which is a non-disclosure agreement for anyone that doesn't know, quickly to explain, non-disclosure agreement is basically a simple legal document that says if you sign it, you're not allowed to share any information discussed between you and whoever else is making you sign the agreement. So if you have a company that maybe you're about to be hired by, or oftentimes when you get hired by a software company, you'll sign an NDA before joining that company, and you won't be over the course of either a certain amount of time, like in this case, 3 years, you won't be able to share any information about this company. Now, that makes sense if you are joining a company that has proprietary software already built and is then going to pay you presumably maybe hundreds of thousands of dollars if you work in tech. It makes sense often to sign an NDA. But if you're going to sign an NDA for something in the ideation phase, it oftentimes means that these people aren't really serious. In my experience, people who are the most concerned about having their ideas stolen, especially when it's literally ideas, it means that they just aren't going to execute and do anything. If you're building something that's valuable and you're uniquely gifted at building, like you should be building this thing, meaning that you have a lot of insight into the market you're building in, you understand where the product will go intimately, you understand how to get customers. It's going to be really hard for anyone to copy what you're doing and execute better than you. That's generally true in tech startups. And to be really coveting an idea, especially an idea that has nothing built yet, that's a bad sign, and it typically means it's a pretty inexperienced founder. And on top of that, this person doesn't even know if they're going to get paid. So if they sign this NDA and there's anything in the NDA that says, hey, you can't compete or work on anything similar to this idea, you might not be able to get a job at other companies that are even kind of similar to this idea, even though it's not even a software yet, even though there's nothing really in the market yet. So it's just generally a bad idea to sign an NDA when there isn't like guaranteed money, or there isn't at least a product that's on market, or you're not working on something that's like a hardware company that's like genuinely really valuable and innovative. I wouldn't sign an NDA in the ideation phase. I would be very careful to. It oftentimes just has more downsides attached to it than upsides, and it's a very bad sign and shows kind of that the founders that you're talking to are very inexperienced. So stay away. Ooh, this is a good one. Next question. VC told us no, but still wants to meet. What to expect? My co-founder and I are building a product that is in closed alpha phase. And Jesus, ever notice how every startup, there's like new closed alpha phase? You mean just like we're not pre-launch yet? I mean, there's just a million fucking closed alpha, beta, gamma phase. We're in private selective beta with limited customer liability. Like everything is just getting more and more good jargony over time. Anyway, I digress. My co-founder and I are building a product that's in closed alpha phase and has received tremendous feedback. Great. We received over 100 signups in less than a month, and we are on track for $5,000 in ARR within 30 days of when we release the public build. For those that don't know, $5,000 in ARR means $5,000 in annual revenue. Given that they've only been out for seemingly 30 days, that's pretty good. It's a good initial sign. 100 signups. I don't know what kind of product, if this is B2B, meaning they sell to other businesses, or do they sell to consumers? Regardless, it seems promising that they have such good early traction. Obviously, $5,000 a month or $5,000 a year in revenue is not going to be a life-changing amount of money, but it's promising for early stage feedback. Lots of startups raise millions of dollars with $0 in revenue and no customers, so this is good. With that information in mind, we reached out to a few pre-seed and seed VC firms to gauge some general interest. One firm that we reached out to told us that they liked the product, but felt like it was too early to invest, and they told us no. Then they, however, said they still wanted to meet, and we have a meeting scheduled with them for next week. What should we expect from this meeting? Are they still gauging if they should invest? I've never been in this situation. With my last endeavor, it seemed always a pretty straightforward yes or no. So a couple reasons why a VC firm may meet with you, even though they initially said no. The first reason, this is one that often founders overlook and don't think about, is that they're just trying to gather information about the market that you're building in. So imagine that this fellow is building an AI startup, and say they're building an AI startup for financial services companies. This VC firm may have a thesis, or they may be looking to invest in AI companies in the financial services space, or AI companies that are in the fintech space, or whatever. And so even if they're not interested in you, if they're interested in investing in AI companies, they'll often send someone to meet with you to gather information. Maybe you have a unique way of getting customers. Maybe you have a unique insight about where you think the industry is going to go. Something that will give the investors more information about the market that they're looking to invest in. Now, this might not actually be that can be a bad or a good thing for you as the founder. It could be a good thing in the sense that, if you really nail that conversation, they may end up being interested in you, even if they were just going into that meeting to information gather and to learn more about the market. But I would say more often than not, it's kind of a neutral or bad sign if they're doing that. It means they may have other companies they're looking to invest in, and they want to compare those other companies to you. And so they're really going to just gather as much information as you, maybe even tell the other companies what you're doing if you figured something out. Like if you figured out an interesting way to get those 100 signups and you tell them and reveal to the investor how you got those 100 signups, they may go give that information to a portfolio company of theirs. Which then leads me to the second reason an investor may want to meet with you, even if they said no. They've already invested in a company that kind of does what you're doing, and they want to gather information from you in order to give it directly to the company that they invested in. That happens all the time. It's a shitty thing that happens. It's not nice, but it's reality. So, if I were ever in a situation, and this has happened to me before while I was pitching investors, I would literally join calls and act like a dumbass, or like reveal as little information as possible to the investor so that I didn't give away any of the trade secrets behind my company. So I would be very tactful about what I would reveal to the investor. And sometimes I would kind of play dumb or, act like I didn't know what I was talking about. And I would try and gather information from them. So I would really be careful not to reveal too much to any investor who says no to you and then wants to meet. In fact, if you join a call like this, you might ask them up front, hey, you already said no. Why are you interested in meeting with us? Ask them immediately. There's, most early stage founders, most founders who haven't raised money have this idea that investors are these special people. They're not. They're human beings like you. And if you come in with a direct question like, hey, you initially said no, why do you want to meet with us? And then you ask the investor lots of questions, you might be able to gather a lot of information about why did they say no? Why did they want to meet with you? And what kind of investments are they actually trying to invest in? And then you can use that information, hopefully, to find other investors or to close other investors who might actually be interested in what you're doing. So you can almost act like a CIA operative, unlike the investor who's trying to act like a CIA operative and gather information about you. So I always would try and flip the conversation on the investor and get as much value out of that conversation as you can, knowing full well that they're probably not going to invest. If anyone says they're not going to invest in me, I immediately just assume they're not going to invest, and I don't care about them a lot. That doesn't mean I'm not respectful, but it means I don't ever act desperate around them even remotely, because why would I? They've already told me they're not interested. My best case for winning them over is to not give a fuck about them. That's genuinely your best bet. So those would be the main reasons why a VC might want to still meet with you. Or the last reason, this is often the least likely reason, although it's the one that most founders want to be true, which is they might kind of be interested in you and they want to build a relationship slowly over time so they can eventually invest in you. This is not often the case. We all want it to be the case because it's the best case scenario for us as founders, but it's not often the case. So I wouldn't really get your hopes up there. I would be careful and assume that if any VC has said no to you and they still want to meet, they're trying to gather information. Who knows what they're trying to do with that information? I've given you a couple options of what they might be trying to do, but be very cautious if any investor is trying to do this. It's generally not a great sign, or if it's not a great sign, it's neutral. It doesn't really mean much. So be careful with what you reveal to them. All right, let's see what next question we got. All right, reality of the valuation of my 1% equity stake. I got an offer to join a startup as a very early engineer. It offers 1% equity, Class C, non-voting shares. That's very standard. The startup has a parent company that is PE funded. The parent company mostly owns the startup, with the only exception being the PE ownership and the startup founders' equity and my equity, and one other early engineer's equity. The founders are looking for a liquidity event in 2 to 3 years. I don't believe there's a plan to IPO, and I don't know what the parent company ever plans to sell the startup. What does the stock valuation? How does the stock valuation work if there is no sale and no IPO? Well, if there's no liquidity event, you never make any money, unless this company eventually pays dividends. But that's a whole other conversation. It's generally not relevant for companies at this stage. So in this situation, what's interesting here is they say the founders are looking for a liquidity event. For those that don't know, a liquidity event means a merger or an acquisition, meaning you're going to be absorbed by another company, or you're going to sell the company to someone else, or you IPO. Although we say here there's no plans to IPO, but it's possible that the engineer just doesn't know that there's no plan to IPO, although it sounds like it's a relatively small company. So I would want to know how many employees are in this company, so that could give us a better sense of whether or not it's even realistic for them to IPO. And then in addition, how much revenue is there? But, what I'd really want to know is, like, how much value is there in this company? Like, is the company generating significant revenue? Is there a proprietary technology that people might want to buy? Those will help you get an idea of whether or not there is actually likely to be a liquidity event. Founders will look for a liquidity event, but if their company's not generating lots of revenue, that's going to be hard. It always is hard, regardless of whether or not your company generates revenue. It's certainly way harder if your company doesn't generate significant revenue. So how does the stock valuation work if there's no sale or IPO? If there's no liquidity event, you never make any money. That's the simple way that it works. Now, if the company generates $100 million a year in revenue, then I'm sure someone will want to buy it, or there could be some form of liquidity event. Or the company will move to doing distributions, meaning that they'll take a portion of the $100 million that you're making every year in revenue and distribute it to the stakeholders of the company. That's how distributions work. Now, that's a really great scenario. That's completely dependent on whether or not your company makes money. But if you don't sell, you don't have a merger and acquisition, and you don't IPO, really your only way of making money out of that company, out of the stock that you have, is through distributions to shareholders, which is pretty rare in startups. It does sometimes happen, and that's how a lot of traditional companies make a lot of money. But if you don't have a liquidity event, nothing really happens with your stock. So it just kind of sits there and goes nowhere. You need a liquidity event to make money. That's kind of the whole point with liquidity events. So there's a final portion at the bottom here. Let's see if there's anything else to answer, and if not, we'll move on. For example, let's say I want to sell my shares in 3 years, and the company had been valued at $200 billion in the last round of funding. Are my shares valued based on the valuation used for funding, or am I at the mercy of the parent company to determine how much my shares are worth, or other? Okay, so that's interesting. So generally speaking, what he's talking about here is selling secondaries, meaning rather than having a liquidity event, you find an independent buyer to buy your specific shares in this company. So if the company is worth $200 million in the last round of funding and this fellow owns 1%, then it's roughly $2 million in stock options that he owns. So if his shares are all vested, meaning he owns all of them outright and he's not slowly earning those shares monthly or every year, then he could potentially and the company allows you to sell secondaries. You might be able to find an independent buyer that likes this company, sees the value in the future, and is willing to buy your shares in the company for at around the $200 million valuation or slightly below it. Secondaries are up to the negotiator, you and the third party, but oftentimes it is at the valuation of the last funding round. But you would need to make sure that your company actually allows you to sell secondaries, so it'll allow you to sell your shares to other people. Not all companies will allow you to do that independently. So you basically would just have to know those two things. But generally speaking, you would be selling at around or at the valuation of your last funding round. That is generally how it works. All right, let's move on. Founder salary expectations. The TLDR on this one. All right, let's get into it. What am I saying? I am the technical founder. For my co-founder is more of a CFO role. So who's the CEO? Whatever, moving on. Our startup is my idea from the beginning. I have the technical know-how to bring this to market. I have little background. We're pre-revenue and have essentially bootstrapped the MVP since early 2020, summer 2022. Okay, so pre-revenue, but maybe they have traction. I am a software engineer with 20 years of experience. I'm the only one working on all the technical aspects. As we're approaching the go-to-market phase, we need to raise capital, and I need to quit my day job. Ironically, my day job was when it was Series A, and now they're gearing up for Series C. I don't really see how that's ironic at all, but whatever. Herein lies the problem. I intend to maintain my current salary for my day job. If you Google senior software engineer salary, the median salary is about $5,000 less than what I make today. I'm cool with the national medium. My co-founder thinks VCs will see this as being excessive for a founder at the seeded MVP round. Early in my career, I was underpaid and was not making great money. All right, so basically, this person wants to make a normal senior software engineering salary. Let's call it like $200,000 a year. But he's worried that if he raises money at a pre-seed or a seed stage, which oftentimes the average amount you're raising is like maybe $1 to $5 million for pre-seed to seed. So this fellow is concerned that if they raise at a pre-seed or a seed stage round, that he's not going to be able to have a normal salary to be able to pay himself, or that he's going to have to pay himself less than $200,000 a year, or whatever median software engineer salary is. This is kind of a tricky one. What I would say is, especially if you don't raise a lot of money, like if you raise less than $1 million, paying yourself $200,000 a year when you raise $1 million that's 1/5 of the amount that you raised. And that doesn't include healthcare and then all the other costs that go into running a company and running a startup. So, the burn will be fairly significant if you raise only $1 million for pay yourself a regular software engineer salary. So I'd say, when most startup founders raise money at the pre-seed and seed stage level, a lot of them will take really low salaries, like 50, 70, 80K, or maybe even less sometimes. But let's say $70,000 is like a median, fairly low tech. That's low for tech, maybe good for other industries, but low for tech. And you as a CEO might take a $70,000 a year salary at pre-seed stage. I've taken that salary before for startups that I've had. Thankfully, I've had other money from other investments and other opportunities, so it wasn't really beating me up at the end of the day. But the reality here being that at the pre-seed stage, $200,000 is a lot. So unless you're raising, say $2 to $4 to $5 million, a normal software engineering salary just for you is going to eat away at a huge amount of the amount that you're raising. So it's kind of hard to justify that. That being said, I'm of the mind that paying yourself $70,000 a year if you run a tech startup that's raised over $1 million is kind of dumb. I think you should be able to pay yourself, say, $100,000, maybe more. I know friends that do $150,000 after they've raised $3 million. The reason I think that's justified is if you're a very talented founder and you're actually working hard, you shouldn't have to be starving or being worrying about your family. But that being said, I think this is more nuanced than just what you're probably going to have to take at a pre-seed stage. Unless your company is crushing it in terms of revenue and traction, you're probably going to have to take less than market rate, at least in the beginning, and then you can bump it up with time, especially as you hit certain traction numbers. So I would set benchmarks and traction metrics that will allow you to increase your salary. But if you really want to go full time on this, it's probably not going to be realistic to pay yourself $200,000 to $250,000 a year when you've only raised one round of funding. That will be a lot of your funding going only to your salary, not including health insurance and every other cost associated with an early stage company. So you're probably going to have to bump it down to $120,000, $150,000, and that would still be relatively high. For a lot of startups, they pay themselves way less than that. So just keep that in mind. Maybe it's not the right time for you. Maybe you need to figure out a way to work and manage the company, or you need to raise a hell of a lot more money to justify it. All right, let's continue. Maybe we'll do one more or two more of these things, and then we'll call it quits here. All right, 1 million free users. Not sure where to go from here. Interesting title. 1 million users is great, but they are free. Let's read into this. I'm a junior developer that launched a website that provides a free service which gets over 1 million users a month. Great. Sorry, I'm losing my voice. Now, I want to monetize my users, and I have a plan to do that. But development of these features would take 1 to 2 years for me to build. Why would it take that long? This person doesn't really give a lot of information about what they're building. I'd ideally want to hire a staff software engineer and a UI developer to help me expedite this while I focus on existing user base, user acquisition, validation. However, I don't have any experience with pitching, getting funding. What would be my best course of action? So if you just have a rudimentary website that provides a simple service that has 1 million users, it's probably not going to be something you're going to raise money for, first of all. Now, the second of all is if you do have 1 million eyeballs a month, and it's 1 million eyeballs in a relatively expensive category. Like imagine you have 1 million software engineers going to your website. That's a really high value user base. They're all people that make a fair amount of money a year, and they're using your product, and maybe they're actively engaged. That is valuable eyeballs. You could sell advertisements. You could implement a simple feature that upcharges. You could try offering coaching, but there's a number of ways to approach this. But my first thing would be to try selling some advertisements, try doing referrals. Referrals are a really simple way to make money. If you can get affiliate links for valuable products, again, if you have a valuable audience, this is way better if you have like software engineers, marketing professionals, real estate brokers, or some sort of audience that makes good money and is a valuable, marketable segment. Like if it's just, 14-year-olds that play video games, 14-year-olds that play video games have no fucking money. So it's 1 million people who don't have any fucking money to pay. So it's not a really valuable segment. But if you have a segment or a group of people that are actually valuable, I would think about like what products do that audience of people that come to your service want? And then I would set up affiliate links to send these customers or these 1 million people to affiliates. If they're buying cameras, for instance, and they buy 1,000 cameras a month, you might be able to make really good fucking money with a 10% affiliate fee for expensive cameras on Amazon. That's a dumb and kind of random idea, but that would be my first and easiest way to go to. I would really try and think about why you need 1 to 2 years. Maybe bring in an outside consultant to help you figure out whether or not it will actually take 1 to 2 years. It seems like you just don't have a ton of experience, which is fine. You've done really well to get this far so far, but I would really try and investigate and maybe hire someone outside, even for a little bit of money, to help you think about what would it actually cost to build out these features and what would be the minimum features required to begin charging your users. And then worst case scenario, look into affiliates. If it's a useful and a wealthy customer segment, you can send them to products and get them to buy products through affiliate links and make a lot of money. Okay, is cold emailing startups for internships acceptable? Just based off the title alone, yes. I have hired numerous interns just because they sent me cold emails. All right, let's read. Current MBA student at a top school in a big city looking to make a transition from consulting into the startup space. I'm not sure on the etiquette around this. Been in corporate my whole life. Fair question then. But is it okay to email startups that look interesting to pitch myself as part-time intern during term time? I'm not particularly fussed about pay. It's more important to start getting that work experience in the startup world and see if I enjoyed and able to make an impact. It is absolutely okay to send cold emails to get an internship. How I would think about sending cold emails for an intern: be fairly concise. You want people to be able to read your email in, say, under 30 seconds. State your value, state why you're reaching out, and state what you think you could do to help them. If they have a specific job title on the website, reach out to them with your job title. Include sexy facts about what you do. I've been a community manager in my past. If I were reaching out to someone for a community manager internship at a startup, I would reach and say, hey, I would presumably reaching out to the CEO. Let's imagine the CEO is Dave. I would write, hey, Dave, I'm Jack. I'm a serial community builder that's built Minecraft servers with 1 million players. I built Discord servers with thousands of members. And I saw that you're building this really cool startup in the community management space. I love the software you're building. I think I could do X, Y, and Z for you. Would love to chat about an internship. I mostly were focused on getting work experience. I'm not too concerned about pay. If it's worth your time, I'd love to chat and see how I could help you guys. Those kinds of cold emails where you state your value clearly and then pitch how you could actually help solve problems at the company, that's your best way of getting a job at a startup. Early stage startups, they have a lot going on, and the founders have a lot going on. But if you can come to them and tell them that, hey, I've identified a problem for you and I'm going to help you solve that problem, it drastically increases the likelihood that you're going to be able to convert that CEO to taking a meeting with you. Propose solutions to problems to founders, and that will drastically increase your likelihood of getting a meeting with them. Just emailing them your resume and saying you're really nice and you think their company's cool, that's not going to have a better effect than, here's who I am, here's what I've done, and here's the value I could provide to your company. Or I've already started writing, here's a couple example tweets that I wrote for your company that I think would get great engagement. If you're trying to get a social media internship, or if you're trying to get a sales internship, send them, hey, here's 4 or 5 customers that I found that I think might buy your product. Here's how I would approach reaching out to them. If you write a cold email that has solutions to problems that startups may have in the email to the startup, the likelihood that the CEO will take a call with you will go drastically up. At the early stage, founders don't have the time and the energy to go through and figure out how they can make use of every person. They need people who come to them with solutions to problems. That is always what startup founders are looking for, and you will rise right to the top of the cold email internship war if you present solutions and make it very clear what value you can provide to the company. And better yet, you can get a head start on providing some value, pulling a list of customers, writing some example tweets, writing example cold emails that you might write to potential customers for them, etc. That shows initiative and will drastically increase your chances of getting an internship. But definitely send the cold email. I've sent thousands of cold emails in my day. All right. Last question we've got here. Anyone used any startup advisors/consultants? I see a lot of people on LinkedIn with these sorts of titles. Seems like the term covers a lot of areas: marketing, design, finance for those that have used them. What did they do for you and how much was it? Was it worth it? Would it be good to know what stage you were at when you hired them? Thanks. Okay. I have a lot of feelings here. Most startup advisors and consultants you see on LinkedIn are fucking scammers. Stay away. I think that advisor shares at the early stage are almost always a waste of your money. Typically, how this works is some person comes to you and says, "Hey, I've been the CMO at multiple companies. If you give me 1% of your company or 5% of your company, I'll let you put my face on your website and in your pitch deck, and I might be able to help you get investors, and I might help you be able to market your product." This almost never works well. There's a couple reasons for this. No one really cares about your company as much as you. Advisors generally don't care about your company that much. They don't have that much time. So, for 1 to 5% and no regular cash flow, why are they really incentivized to help you on a daily basis? And on top of that, do they really know that much about what you're doing to be helpful? If you can't get sales for your company, an advisor almost certainly can't get sales for your company. You as the founder have to be the one pushing the ship forward. And a lot of advisors are just out there to get dumb and inexperienced startup founders to just give them equity and then not really do much and not provide a lot of value. I think advisor shares are best given to people over vesting schedules, meaning that you set clear goals saying, "Hey, I want to bring you on as an advisor. We're going to give you 1/4%, but your 1/4% is going to vest over 4 years." For those that don't know what vesting means, it means that you're only going to get 1/4 of your 1/4% after you've been working with the company for 1 year. And then year 2, you're going to get another 1/4 of your 1/4%. And then you're going to get another 1/4% year 3. So it vests your equity, meaning that advisor gets their 1/4% bit by bit over this course of 4 years. Some advisor agreements are going to be 2 years, but regardless, there should always be a vesting schedule. And I often would always look for advisors who are willing to also invest in my startup. I wanted people who were financially believed in what I was doing, actually had money and resources, so I knew that they were more legitimate than someone who doesn't have money and resources. And at the early stage, someone who's both willing to put money on the line, that's someone who I'm more likely to trust with advisor shares, again, with a vesting schedule. But I would just be very wary of advisors and consultants. You want people that can solve very specific problems. One common issue a lot of startups have is they try and get like a growth consultant or a growth advisor, meaning someone who can actually help them get customers for their early stage company. It's a really bad sign if the startup founder can't get customers and sell to people themselves. Outsourcing sales and growth at the early stage almost never ends well. Most companies fail because they don't close sales on their own, and they outsource their sales and growth and marketing. They pay an agency $5,000 a month to get them 10,000, views on Twitter every month or something like that. And then it just doesn't really go anywhere and work out too well. That's because outsourcing sales is not something you can really do in early stage. It's a founder's job to figure out how to sell the company, how to grow it, and then what do they need over the course of the next couple of years to get to their next milestones, whether it's $500,000 a year in revenue or 1 million users or whatever the case may be. And if you're not figuring that out on your own as a founder, it's going to be really hard for advisors and consultants to help you figure that out. And oftentimes, they're not going to put in the work that you're putting in, and you're just going to give away free equity to people who aren't really going to try that hard and aren't putting money on the line and aren't putting nearly as much time as you on the line. So be very careful with advisors and consultants. I think that it ends poorly more times than it ends well. That doesn't mean that it can't be worthwhile in specific occasions, but I'm very conscious not to accept advisors anymore. I've actually had instances where advisors who've done nothing have come back, after a year, after I've raised millions of dollars and demanded 5% equity in my company, even though they did jack shit and they were just like briefly involved in the early days. And so then we had to deal with that and pay, tens of thousands of dollars to them and tens of thousands of dollars to lawyers to remedy that situation. I've had that happen. And I know a lot of startup founders who've also had that happen. So advisors can be really tricky in the early days. Don't give away too much of your company for free. Put everyone on vesting schedules and make sure that you have clear deliverables if you're going to bring on an advisor. They're going to help you get 10,000 views on a YouTube video. They're going to bring in 5 customer leads every month. They're going to make 50 introductions to investors. Tangible targets to help you so that you know that you're actually getting the value for the equity that you're dishing out. All right. I think that's enough talking for one day. Appreciate everyone tuning in. That's all I got for you today. But as you can see, there's a lot of questions out there on Reddit. I wish these people well. And if this was liked and people like it, just subscribe, drop some comments, and I'll do this again. Hopefully I'll find more juicy and interesting and exciting things from Reddit to dive into. All right. Thanks, everyone.